Okay, hello and welcome to our video here that is going to explain the intuition behind the Gordon growth method that is used in a discounted cash flow analysis to explain the terminal value calculation, or to calculate terminal value. Now, the reason why we're going through this is because it's very, very common to use this formula in a DCF analysis, but a lot of people, a lot of books, a lot of professors actually skip over the real explanation behind it entirely, and that leads to a ton of questions. Out of all the DCF related topics I've covered and taught over the years, the formula for terminal value as calculated with the Gordon growth method or the perpetuity growth method, the long-term growth method, whatever you want to call it, has generated more questions than probably anything else out there. It's interesting to cover because it's not immediately obvious why the formula works the way it does. So we're going to break it down in this lesson, and first, in step one, we're going to go over the formula and the intuition behind it, and then in step two, we're going to go over the mathematical proof for it. So I'll warn you in advance that there is going to be some algebra here, there is going to be some math that we have to do, but if you are more analytical and you want a rigorous proof of how this works, we're going to cover that in step two. So let's start this off with step number one right here first. Now, the familiar formula for this, for terminal value as calculated with the Gordon growth method, is just the final year free cash flow times 1 plus the free cash flow growth rate, and then you divide that whole term by the discount rate minus the free cash flow growth rate at the bottom. Now, just to show you an example of how this comes up, I'm going to jump into Excel and bring up a file that has this and makes use of this formula. So that's an example of how we use it in Excel, and the obvious question here is, what does this actually mean? Why do we subtract the free cash flow growth rate in the bottom? Why do we have that bottom term, discount rate minus free cash flow growth rate? And then what's going on with the top term? Why do we take the final year free cash flow in the period we're modeling and then multiply it by the growth rate? What's the deal with that? What's really going on there? And the basic idea behind this is as follows. How much can we afford to pay for a company's cash flows indefinitely into the future if we want a certain yield on our investment? And that yield, of course, is called the discount rate in this analysis. So to explain the intuition behind this, I'm going to go through two scenarios. The first one here, we're going to have no growth. So the free cash flows we get from the company are going to stay the same every single year. So we're going to skip the growth part for now because it's easier to explain this when we start out with no growth and show you what the discount rate and the net present value and the formula means. And then we're going to add growth once you understand that part so that you understand the entire formula. So here's an example in Excel now from RAL Corp Holdings, a consumer retail company, one of the companies that we cover in some of our lessons and bonus case studies on the site. Now, I'm not going to go over the concept for a DCF here. I'm assuming you already know that, but just to show you a real world example of where this comes up. In this formula for terminal value over here, if you look at this second option, L27 times 1 plus R16 divided by R10 minus R16, well, that is an example of how you use the terminal value formula based on the Gordon growth method. The L27, just a final year free cash flow, 1 plus R16. R16 is the terminal growth rate, and then R10 is the discount rate up here. So that's a real world example of where you use it. And again, the whole idea with the DCF is, of course, to take the present value of a company's cash flows and then the present value of the terminal value, add those two up to get the total value of the firm. So we're focused here strictly on the Gordon growth method used to calculate the terminal value, and then which you discount to get the present value of for use in this formula, in this analysis. Now, the top term in that formula, the final year free cash flow times 1 plus the growth rate, that really just means the first year's free cash flow in the terminal period. So if you have a DCF that you're projecting over 5 years or 10 years, well, this top term is really just the free cash flow in year 6 or year 11 or whatever the case may be, 1 year beyond the period that you're actually projecting the free cash flow of. So it's just the first set of cash flow that you get from the company in that terminal period, which goes on indefinitely. So that part is pretty straightforward to explain. You're just trying to go one beyond the last year in your model. We're going to assume a 0% growth rate for now, so we get the same exact free cash flow every single year. And my question to you is, how much would you pay for this? So if we have this scenario, we have no growth and we get a certain amount of cash flow the same every single year, we're targeting a certain percent yield, how much would you actually pay for a company in this situation? And to answer that question, we're going to jump into Excel now, and I'm going to break it down and show you exactly how much you would really pay for this. Okay, so here we are in Excel, and I'm going to show you a quick demonstration to show you more of the intuition behind this and answer that question of how much you would pay for a company that generates a fixed amount of free cash flows each year if you're targeting a certain percentage yield. Now, here, as you can see, our discount rate, so the yield we're targeting is going to be 10%. We're assuming no growth, and the first year free cash flow. So really that term of final year free cash flow times 1 plus the growth rate, because it's the first part of our terminal period, it's going to be 100 right here. So all these years, year 1 over to year 100, this is our terminal period, what we're not modeling in the DCF analysis, what goes beyond the end of our model there. So for the free cash flow, let's just plot this out and see what happens. So we have 100, and remember, we're saying no growth, so we're just going to take our previous term times 1 plus the growth rate, which of course is just 0, but we're going to have that anyway. And let's take this all the way over to year 100. And as you expect, it's 100 each year. So now the question is, how much would you pay for this? And you can see the answer down here, the free cash flow each year divided by the discount rate. And why is that? Well, very simply, because if you invest 1,000, you get a 10% yield on it. That gives you $100 per year in cash flow. And if you don't believe me, I'm going to show you how Excel calculates it, and then I'll show you our numbers up here and show you how very close, if not the same, they are. So the net present value of free cash flows here is just the initial free cash flow divided by the discount rate. So it's just how much we get each year divided by the yield we're targeting. That tells us how much we can pay for it. Now, technically, I should factor in the growth rate here, but we're just ignoring it here just to show you this basic concept first. So it gives us 1,000. And then in Excel, the way you do this is you use the NPV function. NPV stands for net present value, which I defined down here, how much we can afford to pay today for a series of cash flows that go into the future indefinitely if we're targeting a specific yield to get those cash flows from our initial investment. And if we use the NPV function, look at this. I'm going to say 10%. And then for the values, let's take this whole series of cash flows over here. And look at this. Excel gives us almost the same number, 999.93. So if we had a few more years or a couple hundred more years or something like that, it would actually come out to 1,000 if we made it go into infinity. But you can see right here the concept that in Excel, it matches up because Excel knows what's going on here. It knows what we're doing. And the way we calculate this with this formula is pretty much the same. The only difference is that we only have 100 years in Excel, but we'd have an infinite number of years with this calculation above. So these match up, and it tells us clearly that the NPV of a series of cash flows at a certain discount rate is really just equal to, if we have no growth, the initial free cash flow that we get each year, which is the same in all years here, divided by that discount rate. And that is the intuition behind this part. Okay, so that explains how much you'd pay for a company with the same cash flows each year and the yield that you're targeting. So we assume 10% in that case. Now, what we're going to do now is go into scenario 2, which is what happens when we have growth. So when the company's free cash flows are actually growing each year. So now let's say the company is actually growing its free cash flow. It's still initially $100, but now it's growing that free cash flow by 3% each year, just to give us a low, relatively straightforward number to work with here. Now, you're still targeting that same 10% yield on your investment. So we're still using the same numbers here. And my question to you is, if the company's free cash flows are growing, could you pay more or less or the same as that $1,000 and still get that same 10% yield? So you still want that same 10% yield on your investment, whatever your investment is. The company starts out at $100 of free cash flow, but it grows that by 3% every single year indefinitely. So would you pay more or less than that $1,000 to get that same 10% yield? And the answer, of course, is more. You could pay more than that now because there is growth. So that $100 per year that you start out at initially, well, that's going to grow to a lot more than $100 per year eventually if you're growing at 3% per year indefinitely. And that's the point of subtracting the growth term in the denominator here. When you subtract that growth term, so you have a 10% discount rate, well, you subtract 3% there, you get 7% in the denominator. Now, when you divide something by 7%, it's going to be a lot bigger than when you divide it by 10%, and you're saying effectively we can now pay a whole lot more because we have this growth involved and we're getting more for our money here. So I'm going to go into Excel now and show you how this works there. Okay, now this next scenario down here, scenario number 2, now we're going to say, as I say here, that the company's cash flows are actually growing each year. And the question that I just posed to you is, could you pay more or less to get this same 10% yield that we're targeting? And of course, the answer is more because there's growth. As a result of that growth, the denominator in our equation is going to be smaller. And since the denominator is smaller, we're dividing by a smaller number. The entire term is going to be a bigger number. We can pay more for the company up front. Now I'm going to go into Excel and show you and prove to you why this works the way it does and why the NPV formula is really equivalent to the formula that you use in the terminal value when you're calculating it with the Gordon growth method. So free cash flow, let's take a look at this. We're going to take this initial number, and then remember this time we have 3% growth each year, so we have to factor this in. And let's take our previous term, multiply by 1 plus the growth rate over here, and make sure we anchor this, and then copy this all the way across through year 100. So with that, we can see it goes all the way up to close to $2,000 by year 100 right here. But of course, the relevant question is, what is the net present value? Because of course, money in year 100 is going to be worth far less than money today because we could have invested it and earned something on that in the meantime. The question here, if we're targeting the same 10% yield and the cash flows are growing, how much would you pay? And the answer is the initial free cash flow in this period, so the year 1 free cash flow of 100 divided by the discount rate minus the free cash flow growth rate, which comes out to 1,429 here. And so let's take a look at this formula and see how this works. And then I'm going to prove to you that if you do this in Excel by using the NPV function, it comes out to the same thing. So we take this 100, we divide by the discount rate minus the free cash flow growth rate, 1429, and then let's take a look at this in Excel. NPV, we have the 10% discount rate, and we have these free cash flows through year 100. And it comes out to almost the same number. It's a little bit different, but very nearly the same number. And let's just change the decimal places there. So 1427 versus 1429, so not exactly the same, but you can see it's clearly going to converge on the same exact number. If we had a few hundred more years, it would do that, but you get the idea from this. And the reason, of course, is that the net present value is higher because we can pay more to get that same equivalent yield every single year now because there is growth involved. If we invest 1429, we get 100 the first year. No, that's not a 10% yield. You can look at it yourself. 100 divided by 1429, it's actually around a 7% yield. But the relevant question is, what is that yield in each year going forward? And the answer is in year 2, take it and divide by this. Well, we get to 7%. And I'm actually going to increase the decimals on this so you can see it a little bit better. And take a look at this. The yield here is going up every single year because we're getting more free cash flow from this initial investment. And that is why we can afford to pay more than 1,000, because the free cash flow is going up each year, the yield is going up each year, and no, due to the time value of money, that money in year 10 or year 50 or year 100 is worth less than what is shown in Excel. But when all is said and done, we could still pay substantially more and get that same 10% yield equivalently with these changing cash flow numbers now. So that is how this works. Now, the mathematical proof and the intuition for this, which is the next part I'm going to go into, I'm going to start out very simply here. And what I have here above is just our free cash flow numbers, which are exactly the same as what I linked to above. And then I have the present value free cash flow. To get that present value, we just take our discount rate, 1 plus the discount rate here, and raise it to the power of the year we're in. So up here I have a hidden row with the year numbers over here. So we're just raising it to the power each time. And what I want to do is show you what the cumulative sum of the present value of these free cash flows comes out to each year and show you how it changes. So let's do this, and let's say the sum, I'm going to anchor this first part so this doesn't shift around at all. Have this, and let's just copy this all the way across through year 100. You have that. And so what I want to draw your attention to is the following. The present value free cash flows and the cumulative sum. Look at how these change. Now, over time, present value free cash flow starts off at a decently high number, but it definitely declines a lot all the way to year 10. And then meanwhile, the cumulative sum keeps changing by a smaller amount. And if you keep scrolling over, take a look at this. By the time we get all the way out to year 80 or so, year 81, the present value of free cash flow is almost zero, and the cumulative sum is barely even changing. So what's going on here is that this cumulative sum is converging on a specific number, and the present value is getting closer and closer to zero. So we have an infinite series where the present value, the term in the series, is getting closer and closer to zero as time approaches infinity, and the sum of the series converges on a specific number, so it's a geometric series converging on a specific sum over time. And you can see my explanation down here, but what is happening here is that that number it's converging on is the net present value of free cash flows for this cash flow profile at this discount rate. And so what we can do now is use some algebra to actually calculate what this is and to derive our formula. I'm going to go back to PowerPoint and show you how to do that now. What I want to conclude this lesson by doing is by going through some of the algebra behind it and going through a more rigorous mathematical proof for this. Now, it's not exactly a proof, it's more of a derivation of the formula, but I want to go through it because, again, it's just something that a lot of other training courses, a lot of other companies, books, professors, and so on just skip over entirely. Now, I'll warn you in advance that if you do not like math, you don't like algebra that much, you should probably just skip this part because we've already been over the intuition, and that's really most of what you need to know. But if you are more analytical, you want something more rigorous, we're going to go through that right now. So the idea here is that really we have the sum of a geometric series. And I showed you that before in Excel, and basically what's going on is that over time, the sum of the present value of free cash flows converges to a specific number. And the reason that happens is because the present value of free cash flows gets smaller every single year. So it keeps getting smaller. Eventually, it's going to hit zero at some point far into the future. And so the sum of all those present values of free cash flows approaches a specific number. We have a geometric series. Now, if you want more about this, you can go look on Wikipedia. I don't really have time to explain it here, but you'll see what it is. And it's basically just a series where the sum converges to a specific number over time. And the sum of this you can calculate as a divided by 1 minus r. What does a mean? What does 1 minus r mean? Well, a, in this case, is the present value of free cash flows 1 year into the terminal period of the model. So this is basically the first term of this summation, which of course is just the final year free cash flow times 1 plus the growth rate divided by 1 plus the discount rate. Why are we dividing by 1 plus the discount rate? Well, normally we raise that to the year number, the power of the year number, but we're in year 1, so we just raise it to the power of 1, and it's just 1 plus the discount rate here. And then R is the common ratio. This basically means what you multiply each term in the series by to get to the next term. So R here, what does it mean in this context? Well, in the first year, it just means what do we multiply this term up here, the final year free cash flow times 1 plus the free cash flow growth rate divided by 1 plus the discount rate. What do we multiply that by to get to the present value of free cash flow in year 2? So how do we get to this? What does this actually mean here? Well, in this case, we know that the free cash flow grows by 1 plus the growth rate each year. So that seems pretty straightforward. And we know the present value of free cash flow is just equal to the free cash flow divided by 1 plus the discount rate raised to the power of the year that we're in. So if we're in year 1, it's just 1. If we're in year 2, we raise it to the power of 2, we square it. Year 3, we raise it to the power of 3. So the common ratio is simply 1 plus the free cash flow growth rate divided by 1 plus the discount rate. What that means is that every single year, to find the present value of free cash flow in the next year, we multiply this year's term by this number, 1 plus the growth rate divided by 1 plus the discount rate. So over time, our free cash flows are going to keep growing, but the present value of those free cash flows each year is going to be shrinking because of the discount rate, because money today is worth more than money tomorrow. So this is, as I say here, how much the present value of free cash flow changes over the previous year's number each year. So let's put it all together now and think about how to write this formula. Then we'll use some algebra to combine terms, simplify it, and get down ultimately to a derivation of the real formula for terminal value as calculated by the Gordon growth method. So A is just equal to the final year free cash flow times 1 plus the growth rate divided by 1 plus the discount rate. Straightforward. R is equal to 1 plus the free cash flow growth rate divided by 1 plus the discount rate. So A divided by the term of 1 minus R is this fraction that you see here on screen. I'm not even going to attempt to read this off. It's just easier to look at it yourself and see it all visually. So the question is, how can we go from this ugly looking fraction to our actual formula? How can we go from one to the other here? And to do that, we're going to have to use some algebra and rearrange and combine some of these terms. And basically what we have to do is in the bottom here, in this part, we need to make this a lot easier, and we need to get to the 1 plus discount rate that's at the bottom of this fraction at the top. So I'm going to show you how to do that by using some math right now. So the first thing we're going to do is rewrite the 1 term in the bottom, the 1 minus that 1 part in the beginning, as 1 plus the discount rate divided by 1 plus the discount rate. So it's the same exact thing, but we're doing that so we can get a common denominator at the bottom. So this whole term, that just becomes what you see on screen. 1 plus the discount rate over 1 plus the discount rate minus 1 plus the growth rate over 1 plus the discount rate. And of course, you can combine those two terms and make it equal to discount rate minus free cash flow growth rate divided by 1 plus the discount rate, because the 1 term on the top, that just cancels out entirely because you have a positive 1 and then you have a negative 1. So we're still working with this ugly looking term that I have here on the top of the screen. And now what you can do is rewrite this term, because we just went through some algebra to rewrite the bottom part, and you can rewrite this term as follows. Final year free cash flow times 1 plus the growth rate divided by 1 plus the discount rate. And then you can rewrite that whole bottom part as another fraction, discount rate minus the free cash flow growth rate over 1 plus the discount rate. So now you have a fraction that is comprised of multiple other fractions. You have one fraction on the top, and then you have another fraction on the bottom. Of course, this is very confusing, so we prefer to rewrite this as something else entirely and to simplify it even further. Fortunately, that's very easy here, because what you can do is just multiply these two fractions out. You can flip the denominator and numerator in the second fraction, and then just multiply the first fraction times the second fraction. When you do that, look at what happens here. The first fraction, final year free cash flow times 1 plus the growth rate over 1 plus the discount rate, multiplied by 1 plus the discount rate over the discount rate minus the free cash flow growth rate. And look at this, remember from your algebra and how fractions work, the denominator and numerator here cancel each other out because they're the same thing. So you have a denominator and numerator in two separate fractions you're multiplying that are the same. Well, they cancel each other out, and look what happens. We get to final year free cash flow times 1 plus the growth rate divided by the discount rate minus the growth rate at the bottom, and that is our familiar formula for terminal value as calculated with the Gordon growth method. And we're done. So I know that was a lot of math. It may not have been entirely obvious on screen how everything works, but I just wanted to go through the derivation because I know I'm going to get some questions about this, about the mathematical proof behind it or the derivation. So for the record, I just wanted to go through it and show you exactly how it works. To be clear, this is not at all required for interviews. It's really just for your own information if you really want to understand the details of how this works. If this came up in an interview, the interviewer would not even know how to derive this. 99% of people working in finance would not even know how to derive this at their fingertips. So this is really more for your own information than anything else. The intuition behind the formula is important, but the derivation, this is really just more FYI than anything else. So I know we went through a lot in this lesson. To sum up everything and to go through everything we've been through before. So Gordon growth method, why is it important? It's very common in the DCF as a way to calculate terminal value. And you could just use the multiples method as a simpler method, but it's good to know this as well. And the thing is, when you use a formula like this, you don't want to just use it. You want to understand why it works. Maybe you don't know the full mathematical derivation, but at least you want to be able to understand the intuition behind it. That's important whenever you have a formula like this that's not immediately obvious and you're using it in Excel. The basic idea is that if we're targeting a certain percentage yield, the discount rate, and we know the cash flows we're going to get, we can pay the cash flow each year, assuming no growth, divided by the discount rate, and that's how much we're willing to pay to get those cash flows at the yield that we're targeting. And then if there's growth, we can pay more than that. We can pay the first year free cash flow in that terminal period divided by the discount rate minus the free cash flow growth rate. And we can pay that extra amount. The denominator becomes smaller, and so now we're paying more because we have growth. We're still getting the same yield, but because of that growth that's involved, we can pay more upfront to get that series of cash flows that is now growing. So higher growth means a smaller denominator and we can pay more, and vice versa. If we have lower growth, it means we have a bigger denominator and we can pay less. So that is how the formula works. That's the intuition behind it, as well as the mathematical proof. I hope this clarifies this point and better explains to you exactly how it works. Even if you didn't get all the mathematical derivation and the algebra behind it, at least you should have a better idea of the intuition behind this formula and how to use it and why it works the way it does in a discounted cash flow analysis.